Okay, so let's go over every legal way to take money out of your 401k, to withdraw from your 401k, to tap into your 401k funds without paying a 10% penalty. You see, you do not need to wait until you are 59 and a half to take money out of your 401k. It's a complete misunderstanding that a lot of people have. In this guide, we're going to break down the 7 penalty-free methods, how they work, and exactly how to execute each one. Let's get into it. So method number 1 is a 401k loan. This is where you borrow from yourself without triggering penalties. You can borrow up to 50% of your vested balance, but the max you can borrow is $50,000. There are no taxes on this. There are no penalties on this loan. You're basically paying yourself back with interest. Now, you must repay this within 5 years, and you get a longer time period to pay this back if this is a loan for your primary home. Now, you must charge interest on this loan. You can't loan it to yourself interest free, and that interest is typically the prime rate plus 1%. Well, how exactly do you initiate and receive the loan funds? Well, you just want to log into your 401k portal. You want to find loans or borrow. You want to choose the loan amount and repayment schedule that works for you. Remember, it must be within 5 years or longer if this is your primary home. You want to review the terms, right? Make sure it's correct, your repayment via payroll deductions. And then you want to submit the request, and you'll receive the funds via direct deposit. Now, method number 2 is to create a structured withdrawal plan to avoid penalties. This is when you take substantially equal periodic payments, right? That is what SEPP stands for. Now, there are no penalties if you follow the IRS approved withdrawal formulas, right? Now, you must continue this for 5 years or until you are 59 and a half, whichever is longer. So that is something that you have to keep in mind when going with this route. Now, the IRS does allow you to use 3 calculation methods. The first is amortization, the second is annuitization, and the last one is called RMD. Now, something that you must know, and this is very important, is that you cannot start a SEPP program from a 401k if you are still working for the sponsored employer. You can do this strategy once you leave your job, but you cannot do this while you're still working for the employer and trying to take proceeds from their 401k sponsor. Now, how do you execute this? Well, you just set up IRS approved recurring withdrawals. So you want to work with a CPA or use a 72T calculator. You want to choose one of the IRS approved withdrawal methods. Then simply document your calculations carefully, set up automatic annual withdrawals, and just know that many 401k administrators actually do not allow you to do this simply based on the technical aspects of their platform. So what most people do is that they roll their old 401k into a traditional IRA and then run the SEPP method from there, because your IRA will give you the ability to set up the payments the way you need to run this method. Now, method number 3 is the rule of 55, and that is where you access funds early after leaving your job at 55 or older. Now, this applies if you leave your job in the year you turn 55 or later. Once again, you must leave your job. You can access that employer's 401k penalty free. Now, this works even if you retire, you quit, or get laid off. Now, you will still owe income taxes on withdrawals, so that is something that you need to be prepared for. But with this method, you can access the funds. Now, how do you execute the rule of 55? Well, first you need to confirm that you left your job between the ages of 55 and 59 and a half. Next, you want to contact your 401k provider or HR to verify this eligibility. You want to request a direct withdrawal, not a rollover. Okay, and then plan withdrawals strategically to reduce your taxes. All right, on to method 4, which is a hardship withdrawal. This is where you access funds for immediate and essential financial needs. Now, common reasons to do this are medical bills, right? Buying a home, tuition, or funeral costs. Now, something you must know is that taxes do apply, but the penalty may be waived based on the actual hardship. And this is only available if your plan permits it. So make sure you call up your provider and see if this is an option for you. Now, how do you execute this method? Well, you want to check your plan documents once again to confirm eligibility. Then you want to provide required documentation, so bills, purchase contracts, so on and so forth. Then you submit the request through your plan portal and expect taxes to be withheld at the time of distribution. So that's something that you have to plan for. Now, method number 5 is a disability exception. You meet the requirements if you are totally and permanently disabled, and you must meet IRS strict definitions on what this means. But the withdrawals are penalty free, but taxes still apply here. And documentation from your physician is required here to be eligible. Now, how do you execute this disability exception? Well, you want to obtain a statement confirming permanent disability. Then you want to submit that documentation to your 401k provider. Then request a distribution under the disability exemption and keep your paperwork for any IRS audits or protection. All right, on to method number 6, where your medical expenses are greater than 7.5% of your adjusted gross income. So you can use unreimbursed medical bills to access the funds early. Now, these withdrawals will be penalty free up to the amount exceeding 7.5% of your adjusted gross income. Now, this must be unreimbursed medical expenses, and taxes still apply here. We see a recurrent theme here with that. And this applies for the tax year the expenses actually occurred. So let's look deeper into how to execute this. You just need to calculate qualifying amounts and then support it with documentation. So you add up the total unreimbursed medical bills, you calculate 7.5% of your adjusted gross income, withdraw only the qualifying amount, and then you keep receipts in proof of the expenses. Now on to method number 7, which is birth or adoption. Now you must withdraw within 1 year of birth or adoption, and you can repay the amount later with no limits. Once again, as we see, taxes still apply unless repaid here. How do you actually execute on this method? Well, you simply provide proof of birth or adoption. You request withdrawal under qualified birth or adoption and plan for taxes unless you plan to repay this back, and then repay anytime to restore your tax deferred status. It's that simple. Now, something you must know here is that taxes still apply. Penalty free doesn't mean tax free, okay? Withdrawals are taxed as ordinary income, which pretty much sucks, but that's what it is. And you need to plan withdrawals with tax brackets in mind. You don't want to get caught during tax time with a bill higher than you expected. So consider spreading withdrawals over tax years to minimize that impact. And one of the most important things is that documentation should be kept. So protect yourself for tax filings and audits with medical bills, birth adoption documents, disability physician letters, hardship justification documents, and 72T calculation reports. Let's look at some scenarios where these methods do not apply, right? Penalties will still be there. The first way is when taking cash from an old 401k with no qualifying exceptions. That's a given. The next is early withdrawals simply because you want the money. That won't work. You need to meet qualifications. The next one is accessing earnings from Roth accounts without meeting rules. And lastly, not meeting age or separation requirements. And separation requirements meaning from your job. So you want to choose the path with the least damage, right? Pick the method with the lowest long-term costs. As we see, you have legal ways to access funds without penalties, so choose based on your situation, your timeline, or your tax impact. So those are the 7 methods. What are your thoughts? Let me know in the comments. Are you eligible for any of these methods? Do you plan to take money out of your 401k before you're 59 and a half? And make sure you like this video so it reaches more people who may need to see this video, and subscribe to the channel. My name is Karan, and I'll see you in the next video. Take care.